Module Overview. The Conceptual Framework for Financial Reporting serves as the foundation for the development, interpretation, and application of IFRS. Think of it as the constitution of international accounting. It doesn't override any IFRS standard, but provides the underlying principles and objectives that guide the preparation and presentation of general-purpose financial reports. The framework is used by IASB in developing and revising standards, preparers in applying standards or creating policies where no specific IFRS exists, auditors and regulators in assessing compliance, users in understanding the quality and limitations of reported information. The revised conceptual framework was published in March 2018 and includes significant updates such as better definitions of assets and liabilities, guidance on measurement, presentation, and derecognition. Objective of general-purpose financial reporting. The primary objective is to provide financial information about the reporting entity that is useful to existing and potential investors, lenders, and other creditors in making decisions about providing resources to the entity. This information should help users assess the entity's financial position, resources, and claims, evaluate the entity's financial performance, profitability, cash flows, understand the entity's stewardship and ability to generate future cash flows. Objectives and importance of IFRS. The core objective of IFRS is to provide decision-useful information to a wide range of stakeholders, including investors, creditors, analysts, regulators, and the public. IFRS financial statements aim to be comparable across companies, countries, and time periods, transparent, showing the true financial position of an entity, reliable, based on neutral and verifiable data, consistent, ensuring uniform application across entities and time. Key benefits of IFRS include enhanced investor confidence in financial statements, easier access to foreign capital markets, reduced cost of capital for multinational companies, improved corporate governance and accountability, simplified financial consolidation for multinationals. Fundamental qualitative characteristics of useful financial information. To meet its objective, financial information must possess the following qualitative characteristics. Fundamental characteristics. Relevance, capable of making a difference in users' decisions, includes predictive and confirmatory value. Materiality is an aspect of relevance. Information is material if omitting or misstating it could influence decisions. Faithful representation. Information must be complete, neutral, and free from error. This does not imply perfect accuracy, but the most accurate representation possible. Enhancing characteristics. Comparability enables users to identify similarities and differences across time and between entities. Verifiability. Different knowledgeable and independent observers could reach consensus. Timeliness. Information should be available in time to influence decisions. Understandability. Information should be clearly presented and comprehensible to reasonably informed users. Elements of financial statements. The framework identifies 10 elements divided into two broad categories. Elements related to financial position. Present economic resources controlled by the entity as a result of past events. Liabilities. Present obligations to transfer economic resources due to past events. Equity, the residual interest in the assets after deducting liabilities. Elements related to financial performance. Income, increases in assets or decreases in liabilities that result in increases in equity. Expenses, decreases in assets or increases in liabilities that reduce equity. Other elements, recognized in specific situations. Contributions from owners, distributions to owners, transfers between equity components, gains, losses. Recognition and derecognition criteria. Recognition. An item is recognized if it meets the definition of an element. It is probable that the entity will obtain economic benefits or settle an obligation. It has a cost or value that can be measured reliably. Derecognition. An asset or liability is derecognized when the entity loses control of the asset, the obligation is discharged, cancelled, or expired. Derecognition ensures that financial statements reflect only current assets and liabilities. Measurement bases. The framework recognizes several measurement bases, used singly or in combination. Historical cost, based on original transaction price. Current cost, reflects current price for acquiring an equivalent asset or settling a liability. Fair value, price received to sell an asset or paid to transfer a liability in an orderly transaction. Value in use, present value of future cash flows from using an asset. Fulfillment value, present value of the resources to fulfill an obligation. The selection of measurement depends on relevance and faithful representation, nature of the asset or liability, business model and purpose of holding the asset. Presentation and disclosure. The framework provides guidance on presentation, classifying and grouping similar items and separating dissimilar ones. Disclosure, including relevant supplementary information to enhance understanding, e.g., accounting policies, assumptions, risk factors. The goal is to improve clarity and help users make informed decisions. Capital and capital maintenance concepts. Two concepts are identified. Financial capital maintenance. Profit is earned only after maintaining the opening financial capital. Physical capital maintenance. Profit is earned only after maintaining the operating capacity. The choice depends on user needs and business environment. Case illustration, applying the framework. Scenario, a company incurs R&D costs to develop a new medical device. Using the framework. Asset, yes, if the development phase meets recognition criteria. Measurement, initially at cost, possibly revalued later under IFRS disclosure, required to ensure transparency regarding assumptions and risks. Summary of key concepts. The framework is a guide, not a standard. It underpins IFRS. It promotes high-quality, consistent reporting. Understanding the framework helps apply IFRS in ambiguous scenarios. Core elements. Objective, qualitative characteristics. Elements, recognition, measurement, and disclosure.